If you want to find the fastest growing technology ecosystem in retail right now, do not look in Silicon Valley.
No, definitely not.
Right. You actually need to look for a heavy, reinforced square metal truck just rolling down a city street.
A Brink's truck.
Exactly. Today, we are opening up a stack of sources surrounding the Q1 2026 earnings report for the Brink's company. Ticker symbol is BCO, for those of you following along.
Yeah.
And the mission for this deep dive is to figure out how a 160-plus-year-old company, one that's famous for guys with sidearms moving bags of paper money.
Yeah, the classic image.
Right. How that company secretly became this high-margin tech juggernaut, pulling in over $1 billion in profit.
It really is a phenomenal repositioning of a legacy brand. I mean, when you look at their strategic pivot over the last few years, Brink's is actively dismantling the idea that they are just a transportation company.
Which is wild, because that's all anyone knows them for.
Right, but they are no longer simply moving physical paper money from point A to point B in a locked metal box. They're digitizing, analyzing, and managing the entire life cycle of physical money for global enterprises.
I have to admit, digging into these Q1 2026 numbers was a bit of a shock for me.
Oh, I bet.
Because, we live in an era where everyone just assumes cash is a relic.
Yeah.
You tap your phone, you swipe your watch, and cash just seems like it's dying.
Yeah, the whole cashless society narrative.
Exactly. But you look at the financials in these sources, and they paint an entirely different picture.
They really do. The financial snapshot here is remarkably strong, especially given that broader macro narrative about cash that you just mentioned.
Yeah.
For the first quarter, their total revenue hit $1.38 billion.
Wow.
Right. That is up 10% year over year. And we should probably note that about 4.5% of that was pure organic growth.
So it's not all just like currency fluctuations or them buying other companies?
Mm-hmm. Exactly. And looking at the bottom line, they comfortably beat expectations on earnings, too. Earnings per share came in at $1.80, blowing past the consensus estimate of, I think it was $1.59.
Yeah, $1.59. But the metric that really jumped off the page for me, the absolute headline grabber, is their adjusted EBITDA.
Oh, yeah. That's the big one.
According to the report, for the trailing 12 months, Brink's hit $1 billion in adjusted EBITDA for the very first time in their entire history.
Which is huge.
Plus, their trailing 12-month free cash flow exceeded $502 million.
Reaching $1 billion in trailing 12-month EBITDA is, well, it's a definitive market signal. It proves their underlying strategy is not just some, theoretical pivot.
Right.
It's a functioning machine that is throwing off a tremendous amount of free cash flow.
Okay, let's unpack this, because I have to push back on the premise here just a little bit.
Sure, go for it.
We are sitting in 2026. The actual volume of physical cash changing hands at the consumer level has been shrinking for years.
Oh.
So, if the total addressable market of physical paper money is declining, or, at best staying flat, how on earth is a legacy cash logistics company pulling in $1 billion in profit? It just feels entirely counterintuitive.
It seems counterintuitive until you look at the actual mechanism of their profit. The secret isn't that the total volume of cash in the world is drastically increasing.
Okay.
It's about Brink's fundamentally changing the service they provide to their clients. They are capturing significantly higher margins on the cash that is still circulating.
Oh, so?
Think of it like this. They aren't getting paid just for the mileage of the truck anymore. They are getting paid for the software integration, the hardware leasing, and the financial reconciliation.
Oh, I see. So even if the pie is shrinking, their slice of the pie is much thicker because they are doing more valuable work.
That is the core of it. They expanded their EBITDA margins by 10 basis points overall this quarter.
Nice.
And if you look closely at their North America and Rest of World segments, they actually expanded margins by over 100 basis points.
That's math.
It is, and they're doing this through incredibly strict pricing discipline, but the real driver is a massive structural shift toward recurring high-margin revenue streams.
Which brings us to the alphabet soup in their earnings report. The sources keep pointing to two specific acronyms driving all this margin expansion, AMS and DRS.
Right, so AMS stands for ATM Managed Services, and DRS stands for Digital Retail Solutions.
And these two segments are just absolutely on fire. The breakdown shows they saw roughly 15% organic growth this quarter alone.
Yep.
And this isn't some, one-off spike. This is their 13th consecutive quarter of hitting at least 15% growth in these areas.
It's incredible consistency.
Right.
And Brink's management expects these specific services to make up a full third of their total company revenue by the end of the year.
That represents a massive transformation of their business mix, from low-margin logistics to high-margin tech services.
Exactly.
To make this concrete for you listening, I've been thinking about this shift using a specific analogy. Instead of just being the Uber of cash, where a store calls them and they show up to give the money a ride to the bank.
Right, the old model.
Right. Instead of that, Brinks is becoming the AWS of cash.
The Amazon Web Services of cash. I like that. That frames it perfectly. Take that a step further, though. How does that actually map to their operations?
Well, think about what AWS did for the internet. You don't buy your own physical servers anymore. AWS provides the hardware, the software, the security, and the API integrations.
Yep.
And you just pay a monthly fee for the capability. Well, Brinks is doing that exact thing for physical money in retail environments.
They provide the hardware in the store, the proprietary software, the point-of-sale integration, and all the accounting in the background.
Exactly.
That is the textbook definition of DRS, their digital retail solutions. And the earnings report provides a fantastic real-world case study of this with a company called Paradies.
Let's dive into Paradies, because if you've been in a major North American airport recently, you've probably bought a coffee or a sandwich from them.
Most likely, yeah.
They operate over 700 airport stores. They run the franchises for brands like Chick-fil-A, Starbucks, Jimmy John's, and even Toomey inside the terminals.
That's a lot of locations.
Looking at the sources, I can only imagine the absolute nightmare of managing cash tills across 700 fast-paced airport joints.
Oh, just picture the legacy workflow for a store manager in that environment. At the end of a shift, a manager has to pull the drawer, manually count the register, reconcile it against the receipts,
Takes forever.
put the cash in a tamper-evident bag, walk it to a backroom safe, and then wait for an armored truck to arrive on a fixed schedule.
And the kicker is, Paradies as a corporation doesn't actually get that money deposited into their bank account until the truck physically navigates airport security, picks up the bag, drives it to a processing center, counts it again, and wires the funds.
Which can take days, tying up millions of dollars in working capital. But look at what Brinks did here. They didn't just bid on a contract to send trucks on a tighter schedule.
Right.
They proposed a bespoke technological solution. They went into those 700 Paradies locations and installed front office recyclers and smart safes right at the point of sale.
Let's pause there, because front office recycler sounds like some serious industry jargon. What does that machine actually do? Is it just like a heavy metal box with a slot?
No, think of it more like a highly sophisticated mini bank branch sitting right under the counter.
Okay.
A cashier can feed a stack of mixed, crumpled bills directly into the machine. It instantly authenticates them, counts them, sorts them by denomination, and securely holds them.
Wow.
And if a customer hands over a $100 bill for a $5 coffee, the machine automatically dispenses the exact correct change back to the cashier.
That completely removes the human error of making change, and I guess counting the till at the end of the night.
What's fascinating here is how this alters the underlying financial physics of the retail store.
How so?
Because that machine is connected to the internet and linked directly to Paradies' point-of-sale software. The moment a $20 bill drops into that safe, it is instantly digitized. Brinks essentially advances that money electronically to Paradies overnight.
Oh, wow. To push that AWS analogy further, just like Amazon realized unused server space was a wasted asset they could monetize, Brinks realized that cash sitting idly in a register is a wasted asset.
Exactly.
By digitizing it instantly, they've turned static physical cash into dynamic data.
The cash might still politically be sitting in a metal box in an airport terminal in Atlanta, but on Paradies' corporate balance sheet, it is liquid, deployable working capital by the very next morning.
And from the Brinks side, this changes their entire cost structure. Under the old logistics model, Brinks had to send a truck to that airport terminal every Tuesday at 3 p.m., regardless of whether the safe had $50 or $5,000 in it.
Which is wildly inefficient. Now, they have a centralized dashboard showing the real-time cash levels of every single smart safe across all 700 Paradies locations.
That's incredible.
And because the money is already credited to the retailer digitally, the physical cash doesn't need to be picked up immediately. Brinks can use their own optimization algorithms to route their trucks dynamically.
So they only send a truck to empty a safe when it's entirely full.
Right, or when their route mapping determines it's the absolute most fuel and labor efficient time to do so.
They dictate the logistics on their own terms, not the customer's rigid schedule. It makes total sense why their margins expanded so much. And the sources note they are rolling this out
But
globally.
yeah, they're moving fast.
They just secured a big DRS win with Pandora across North America. And on the AMS side, the ATM managed services, they just landed a contract to manage 5,000 ATMs for Indonesia's largest national bank.
It creates an incredibly sticky product. Once a retailer or a bank integrates Brink's hardware and software into their core daily operations, they are not going to rip it all out and switch vendors just to save a few pennies on an armored truck route.
Right.
The switching costs become astronomically high.
But here is the bottleneck.
Uh.
If Brinks has to win over retailers and banks one by one to install these smart safes and ATM modules, achieving massive organic growth is going to take decades.
Yeah, it's slow going door to door.
Exactly. To truly become the foundational infrastructure, the AWS of cash, they need network density overnight, which naturally leads us to the $4 billion elephant in the room.
NCR Atleos.
Yes.
The pending acquisition of NCR Atleos is the ultimate accelerant for this exact strategy. They recently filed their registration statement and expect to close the deal by the first quarter of 2027.
Here's where it gets really interesting.
Mm-hmm.
And frankly, where I have to push back again.
Right, lay it on me.
They are spending $4 billion to buy an ATM company. In 2026, buying a massive fleet of ATMs feels a bit like Blockbuster doubling down on VHS tapes.
That's a fair comparison.
Aren't ATMs a melting ice cube of a business?
Yeah.
How does management justify swallowing a $4 billion company with that kind of profile?
It is a totally valid concern, and it's the primary question institutional investors are asking right now. If you view ATMs merely as cash dispensers for consumers, it absolutely looks like a declining asset.
Right.
But Brinks views ATMs differently. They see them as distributed network nodes. NCR Atleos has a massive existing footprint of retail cash infrastructure.
Okay, I'm following.
By absorbing Atleos, Brinks isn't just buying cash machines. They are buying the prime real estate, the existing banking contracts, and that overnight network density.
So they're basically buying the pre-built grid, and then they can run their higher margin AMS software and routing algorithms through that grid.
Exactly. And the financial maneuvers they are making ahead of the close show how much leverage they really have. Brinks recently stepped in and refinanced Atleos' $1.6 billion bank debt.
Wow.
Because Brinks has a stronger balance sheet, they secured a rate that is more than 100 basis points lower than what Atleos was paying on its own.
If you aren't familiar with corporate debt structures, refinancing at a rate that much lower means the broader market views the combined post-merger entity as drastically less risky than Atleos was as a standalone company.
Spot on.
That is instant financial value creation before the deal even closes.
And beyond the debt savings, Brinks expects to realize about $200 million in immediate cost synergies.
It's just by cutting the fat.
Yeah, simply by eliminating duplicative public company costs. Things like duplicate boards, accounting firms, and global procurement overlaps. Ultimately, they project the combined companies will generate a staggering $1 billion in free cash flow.
But taking down a target that size brings massive execution risk. Management estimates their pro forma leverage, the ratio of their debt to their earnings, will jump to around 3.4 times when the deal closes.
That is high.
Yeah, they're getting uncomfortably high for a capital-intensive business.
It is a real vulnerability window. They project they can aggressively pay down that debt and get leverage below 3 times by the end of 2027, but any macroeconomic hiccup during that window could really squeeze them.
For sure.
Plus, a deal this size requires complex regulatory and shareholder approvals across multiple international jurisdictions.
Not to mention the distraction factor.
Yeah.
We just spent 10 minutes talking about how beautifully the core AMS and DRS businesses are running.
Right.
How does management ensure this massive $4 billion integration doesn't cause them to take their eye off the ball and ruin their current momentum?
Well, the sources outline a very specific mitigation strategy for that exact risk. Brink's leadership has isolated a dedicated integration management office. This team is entirely walled off from day-to-day operations. Their sole mandate is to navigate the regulatory hurdles, plan the technical integration of Atleos, and capture those $200 million in synergies.
Oh, that makes sense. So the executives running the day-to-day truck routes and software deployments aren't spending half their week in, boring merger meetings.
Precisely. The core business leadership is mandated to stay hyper-focused on hitting those mid to high teens organic growth numbers in AMS and DRS.
They need to keep the engine running.
And they absolutely need that operational focus because while the NCR Atleos deal is their strategy for the future, the company is actively operating in a highly volatile present.
That is a perfect segue into the geographic realities of their business.
Yeah.
Because when you operate in over 50 countries, global macroeconomics and geopolitics aren't just things you read about in the news.
No, not at all.
They dictate your daily P&L. Let's look at Brink's Global Services, their international logistics arm known as BGS.
BGS had a surprisingly robust first quarter, and the underlying driver is a direct reflection of current events. Yeah.
The sources attribute a significant portion of BGS's strength to global volatility, specifically the instability in the Middle East.
If you're listening to this and wondering why a geopolitical conflict halfway across the world helps an armored truck company hit their quarterly earnings estimates, you have to think about what happens to institutional money during a crisis.
It flees risk.
Exactly. It flees risk and moves to safe haven assets.
And the ultimate physical safe haven asset is gold. When geopolitical stress spikes, sovereign wealth funds, central banks, and large institutional investors move massive amounts of precious metals in and out of global financial centers like London, Zurich, and Dubai.
But those gold bars don't teleport.
No, they certainly do not.
They have to physically cross borders on
Right.
secure aircraft and in heavily guarded convoys. And Brink's is the preeminent logistics engine for that movement.
It's a fascinating reminder that our highly financialized digital economy still ultimately settles on hard physical assets during a crisis.
It really is. That global footprint also exposes them to massive currency swings, though.
Oh, absolutely. In just the first 3 months of 2026, Brink saw roughly a $71 million revenue tailwind simply from favorable foreign exchange rates.
Mostly driven by the strength of the euro and the Mexican peso against the dollar.
Right, but then you look at the other extreme of their foreign exchange exposure, Argentina.
Oof, yeah, Argentina.
The financial mechanics of running a profitable business in Latin America right now are mind-bending. Argentina is dealing with severe hyperinflation. To give some context, the Argentine peso dropped 29% against the US dollar in 2025 alone.
That's brutal.
Now, it did claw back and appreciate about 5% in the first quarter of 2026, but the macroeconomic environment remains incredibly chaotic.
Operating in that kind of environment requires an entirely different set of accounting principles. Standard GAAP accounting completely falls apart when a currency loses a third of its value in a single year.
So what do?
So Brink's is required to use what is called highly inflationary accounting for their Argentine operations.
Break the mechanics of that down for us. What does highly inflationary accounting actually require a company to do on their balance sheet?
Essentially, it forces a company to strip out the distortion of the collapsing local currency. Because the Argentine peso is devaluing so rapidly, holding assets in pesos is basically a guaranteed loss.
Right.
So under highly inflationary accounting, Brinks must continually remeasure their peso-denominated monetary assets, like their cash reserves and accounts receivable, into U.S. dollars at every single balance sheet date.
Wow, so they are continuously re-rating their books to reflect the actual real-time purchasing power of the money they hold.
Yes, they take immediate hits on the monetary assets they hold in pesos, and that forces the local management team to relentlessly focus on cash velocity.
Meaning what, exactly?
Getting pesos in the door and either deploying them into hard assets or converting them out of the currency as fast as humanly possible.
And what's staggering is that despite operating in a hyperinflationary environment where the currency is collapsing, the sources show Brink's maintained a 16.7% operating margin in their Latin American region.
Which is just a testament to their operational discipline.
So what does this all mean? How does a single corporation absorb a currency crisis in Argentina, an acquisition of a $4 billion company, and geopolitical conflicts in the Middle East, and still manage to post record profits?
This raises an important question about the nature of resilience in modern multinational corporations. For Brink's, the answer is aggressive diversification.
Right.
Their geographic footprint and their service mix act as a shock absorber. When a local market like Argentina is battling massive currency devaluation, their European and Mexican markets are providing $71 million in foreign exchange tailwinds.
They're hedging the globe against itself.
Exactly. When retail transactions might soften in one specific region, Rising geopolitical stress triggers a surge in high-margin logistics demand for their precious metals division.
That's brilliant.
They have built a portfolio of businesses that are diversified enough to not only absorb global shocks, but actually harness volatility as a catalyst for growth.
It really is a masterclass in corporate structuring. Which brings us full circle on the journey we've taken today through these earnings reports.
It's been a ride.
We started with the popular perception of Brinks as a heavy industrial dinosaur moving bags of cash. But the reality is they have evolved into a highly profitable, tech-enabled ecosystem.
Through their AMS and DRS segments, they've figured out how to integrate proprietary hardware and software directly into the back-office operations of thousands of global retailers and banks,
Turning physical cash into dynamic working capital.
reaching that milestone of $1 billion in trailing 12-month adjusted EBITDA proves the model works. And now they are using that massive cash flow to stage a $4 billion acquisition of NCR Atleos to instantly scale that network density.
All while successfully navigating one of the most volatile geopolitical environments in recent memory.
You know, if we step back and connect this transformation to the broader macroeconomic picture, I think there's a really profound takeaway here for anyone interested in how commerce actually functions.
Lay it on us.
Think about the illusion of seamless digital commerce. When you are rushing through an airport and you tap your phone to pay for a coffee at a parody store, the transaction feels entirely weightless.
It feels purely digital.
Right. But beneath that simple tap on a screen, there is an incredibly sophisticated, multi-billion-dollar physical infrastructure operating in the shadows.
The smart safes under the counter, the front office recyclers instantly authenticating the bills, the algorithmic software routing the armored trucks.
All of that heavy physical machinery is absolutely necessary to ensure that the physical cash backing our entire digital economy actually balances, reconciles, and flows efficiently.
Wow.
It begs a really provocative question. As we rush toward this supposedly cashless future, does that future actually require more sophisticated physical cash infrastructure than we ever imagined?
That is a brilliant thought to leave on. Because the next time you see one of those heavy, square metal trucks rolling down the street, you won't just see a relic of the past.
Not anymore.
You are looking at the physical router for the digital economy. For everyone listening, keep tapping those cards and swiping those phones, but don't forget the invisible billion-dollar infrastructure working behind the scenes to make it all possible. We'll catch you on the next deep dive.